Returning to some breaking news we brought you just a short time ago, the third quarter ABS inflation data has just dropped. CPI rose 0.5% over the quarter and 1.7% year on year. This result was in line with analyst expectations, but to break it down, we're joined live now by KPMG Chief Economist Brendan Ryan. Brendan, what's your take on today's read?
Oh, look, I mean, it still shows quite a weakness with regards to just price inflation within Australia overall. We've got underlying inflation of only 0.4% quarter on quarter and 1.6% over the year. And so that's still well below the RBA target band of 2 to 3%. What that suggests to me is certainly that further interest rate cuts are on the table and possibly by the end of the year as well.
So do you think that the RBA target that you mentioned should be lowered?
No, I don't. Personally, I think that, there's the target of 2 to 3% represents a reasonable range in which to maintain price stability within Australia. And where we are at the moment is representing both a combination of some structural changes and also some cyclical reflex as well. So between the two of those, I think that the Australian economy having that target of between 2 to 3% does make sense. But ultimately where we are at the moment is in a period of price weakness.
Now, the big discussion is going to be what impact this might have on interest rates set by the RBA. That's due for another decision next Tuesday. Do you think that this is likely to push them to make another cut?
Look, I think it will. I know that there's lots of talk now about the lack of effectiveness associated with RBA cuts. But ultimately, if we're needing to stimulate the Australian economy and the federal government isn't implementing any form of fiscal stimulus, then we're relying very heavily on the Reserve Bank to do the lifting with monetary policy. Now, the other factor in here too is we're really trying to keep the Australian dollar low to enable export growth and to help pump the economy that way. With other central banks also going through easing cycles at the moment as well, there's not only domestic issues in play with regards to whether we should be keeping rates lower and lower still, but there is that international pressure as well.
We heard in the RBA governor's speech last night, he was saying that we should have less of this focus on inflation. But as you say, that with the lack of fiscal stimulus, do you think that he could be backed into this corner because the government isn't engaging in those extra business investments that he's been suggesting?
Look, I think that, in situations where the economy's weak, you want to have all the levers available to you working. At the moment, what we can see is really there's only one of those levers happening at the moment, which is monetary policy. It's also important to know where we are with regards to just the overall strength of the economy too. It's weak, but it's not in shambles. And so I can understand some hesitancy with regards to going hard with regards to fiscal stimulus. But in the absence of the economy growing and aggregate demand increasing somewhat over the next short term, then pumping the economy with a fiscal stimulus should be something that we should be looking at as well.
So the interesting thing from the speech last night was the RBA governor talked down the prospect of negative interest rates, talked down the prospect of quantitative easing, but said it was time for business to start taking advantage of where these negative interest rates are. If they don't do that, is that not going to force those options anyway?
Look, that's a really tough question. The reason being what investment opportunities are businesses looking at and what's actually holding them back from making those investments. It's certainly not pricing of debt. It may be the availability of debt, which actually goes to the availability of that credit. But I think there's a number of factors that need to be taken into consideration. And the other one that was also mentioned recently as well is how individual businesses are comparing the likely return from a new investment to what their hurdle rates are. And historically, those hurdle rates have been higher because the cost of debt and the risk-free rate have been higher than they are now, but they seem to be permanently lower. And so whether or not businesses are not investing because they're applying these old hurdle rate measures against current and risk-free rate levels.
And just finally, the call from Labor has been that the government needs to eat into its planned surplus to create more stimulus. Do you think that this is going to put pressure on the government to do that, or are they going to hold firm?
Oh, look, I think that the opposition could be calling for the stimulus, and I think there's numbers of other people in the community calling for the stimulus as well. It does seem quite firm that the government is wanting to maintain its surplus and not just fall over the line with a small one. So I think that the government's going to continue to hold firm probably until next year's budget. I don't expect major spending announcement in my EFO, but whether or not that's the right decision is another question indeed.
Absolutely. Thank you so much for your time, Brendan Ryan from KPMG.
Thanks very much for your time.